As of the last market close on Monday, June 22, 2026 at 4 p.m. Eastern Time, Navitas Semiconductor is trading at $24 per share on the Nasdaq under the ticker symbol NVTS, experiencing a minor daily decline of 1.33% during the standard session. While a quick look on a standard individual brokerage account shows a small slide for the day, what most retail traders are completely missing is the staggering backdrop of institutional volume that quietly accumulated this asset over the last month, turning a formerly obscure microcap name into a scorching hot semiconductor runner over 200% year-to-date. The immediate expectation among casual market observers using basic investing sites is that Navitas is just another volatile, unprofitable small-cap chip stock riding the coattails of giants like Nvidia stock. The general belief is that without positive net income, small hardware plays are inherently dangerous bets in a macroeconomic environment marked by sticky inflation and shifting interest rates. However, the underlying reality presents an entirely different picture, as a structural transition from silicon to wide bandgap materials like gallium nitride and silicon carbide is rapidly picking up speed, dragging Navitas straight into the heart of high-power hardware infrastructure. If you open up the Fidelity mobile app or pull up a watch list on your Robinhood app, you might notice that trading volumes for Navitas have spiked dramatically, often exceeding 25 million shares a day compared to its historical averages. This massive liquidity surge is directly tied to a major institutional shift. Large asset management firms are increasingly allocating capital away from overextended multi-trillion-dollar names and rerouting it toward high-conviction supply chain enablers. When you look at platforms tailored for active traders, such as the Interactive Brokers trading platform, the data reveals significant block trades indicating that institutional exchange-traded funds and specialized technology accounts are building long-term positions in this name rather than treating it as a short-term trading vehicle. Recent stock movements have been nothing short of a roller coaster, with the price rebounding from an all-time low around $1.50 earlier in the year to a massive 52-week high of $34.17 earlier this June. This dramatic expansion was supercharged when the market reacted to major public market events like the massive SpaceX public listing, which acted as a massive signal for high-growth hardware enterprises. Active participants using platforms like SoFi Invest or checking their accounts through Fidelity brokerage services have seen the daily swings create immense technical volatility. This high beta nature means that while the broader Nasdaq Composite Index moves by 1% or 2%, Navitas frequently logs double-digit swings as investors digest new order pipelines and corporate guidance. The financial performance reported in their recent first-quarter earnings statement shows how expectations are starting to collide with an accelerating financial reality. Navitas reported quarterly revenues of $8.6 million, beating the consensus estimate of $8.2 million, driven by an 18% sequential increase. More importantly, the leadership team provided exceptionally bold guidance for the second quarter, projecting $10 million in revenue, which stands far above what analysts were modeling. For a self-investing individual utilizing tools like Schwab Intelligent Portfolios or exploring online investing options, analyzing these inflection points is crucial. It shows that the firm is successfully migrating its business model from lower-margin consumer electronics fast chargers to high-power environments such as artificial intelligence data centers, industrial grids, and automotive platforms. To understand why this small company is suddenly attracting the kind of intense attention typically reserved for Tesla stock or Apple stock, we have to look closely at what they actually manufacture. Navitas specializes in gallium nitride and silicon carbide power chips, which are materials that can handle drastically higher voltages, currents, and switching frequencies than traditional silicon. In simple terms, when an artificial intelligence data center runs massive server clusters, traditional power management systems waste enormous amounts of energy as heat. By implementing gallium nitride architectures, operators can dramatically boost power density and cut down on cooling costs. This specific technological edge is what led to their newly announced collaboration with the Nvidia MGX ecosystem to accelerate 800-volt direct current infrastructure, a development that caused the stock to squeeze upward by 20% in a single trading session. For anyone managing their portfolio via a Robinhood stock trading account or setting up long-term assets within Fidelity IRAs, it is important to distinguish between historical metrics and forward-looking product adoption. Historically, Navitas operated at a loss, burning cash to fund heavy research and development, which caused its net profit margins to look deeply negative on standard corporate screeners. Older financial reports from late last year painted a picture of a company struggling with the smartphone and laptop slowdown as consumer spending cooled off.
However, the corporate pivot toward heavy industrial electrification and grid infrastructure has fundamentally altered their target addressable market, which management expects to scale toward $3.5 billion by the end of the decade. Please comment below with how many shares of Navitas Semiconductor you currently hold, or if you prefer sticking to larger chip names for your portfolio. Hearing your perspective on whether small-cap semiconductor producers can survive against the massive capital budgets of mega-cap players helps create a much clearer picture of retail sentiment. When evaluating the future outlook for this company, the ultimate tension lies in balancing their immense structural growth potential against execution risks. On one hand, the demand catalyst from enterprise data centers is incredibly real, as cloud service providers are desperately searching for hardware that can minimize power consumption. On the other hand, the company faces intense competition from established semiconductor heavyweights who are also building out their wide bandgap portfolios. Furthermore, Navitas recently issued over 3 million new shares to satisfy obligations connected to past merger milestones, a move that introduces near-term equity dilution that can act as a temporary headwind for the share price. Traders utilizing advanced accounts like an interactive broker's account or running automated strategies through a SoFi robo-advisor must closely look at the upcoming quarterly report expected in early August. If the company successfully meets or exceeds its non-GAAP gross margin guidance of nearly 40%, it will confirm that their manufacturing scale is improving and that they possess genuine pricing power. Conversely, if supply chain bottlenecks or delayed capital expenditures from their Tier 1 automotive clients slow down shipments, the stock could easily retest lower support levels, giving back a portion of its massive year-to-date gains. When you look at the landscape of online investment opportunities today, the contrast between expectations and reality becomes the defining factor for long-term returns. The initial market expected Navitas to fade away as a speculative post-SPAC casualty that couldn't survive the downturn in consumer tech. The reality is that through disciplined engineering, strategic board appointments of veteran semiconductor executives, and high-profile partnerships with market leaders, they have transformed themselves into a vital component of the infrastructure grid. Whether you monitor your holdings through specialized Fidelity investments, navigate the markets via a mobile Robinhood investment setup, or deploy sophisticated capital using interactive broker stock trading tools, understanding these deep operational shifts is what separates informed investors from the crowd. Ultimately, Navitas Semiconductor represents a classic high-risk, high-reward hardware play, where the underlying technology is moving much faster than the public market's traditional valuation models can track. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bye. Don't forget to like, comment, and share this video to support the channel. Heart.